The number most investors. There is a number sitting in your silver stack right now that most investors have never calculated. Not the spot price, not the total ounces you own, not even the current market value of your position. Surprised? It is a number called your cost basis, and it is the single most important calculation you will ever make as a silver investor. Because when you sell your silver, whether that is next month or 10 years from now, the difference between knowing your cost basis and not knowing it could be thousands of dollars, potentially tens of thousands of dollars on a meaningful position. Here is the core of it in one sentence. Your cost basis is what you paid for your silver, including every legitimate expense associated with acquiring it. The IRS uses your cost basis to calculate your taxable gain. We're serious. Your taxable gain is your sale price minus your cost basis. If you cannot prove your cost basis, the IRS assumes it is zero. Zero cost basis means your entire sale proceeds become your taxable gain, not the profit you actually made, every single dollar you received. Today I am going to walk you through exactly how to calculate your silver cost basis correctly. What expenses qualify to increase your basis and reduce your tax, the specific scenarios that change how basis works, including gifts and inheritance, and the one spreadsheet every silver investor needs to build today, regardless of how long they have been stacking. This is the most practical video in this entire series, and it is the one that will directly save you money the next time you sell. This is rate scope logic, not hype. Before I get into the calculation, let me show you exactly how significant the cost basis number is in dollar terms. Because until you see the math, the dollar math that makes the urgency does not feel real. Let us say you bought 100 ounces of silver in 2020 at $22 per ounce. Your total purchase cost was $2,200. Silver is currently trading around $85 per ounce. If you sell those 100 ounces today, your proceeds are $8,500. Your actual taxable gain is $8,500 minus $2,200, which equals $6,300. At the 28% collectibles rate, your federal tax is $1,764. Now here's what happens. If you cannot prove that $2,200 cost basis, the IRS assigns a basis of zero. Your entire $8,500 in proceeds becomes taxable gain at 28%. That is $2,380 in federal tax. The difference is $616 on just 100 ounces. Now multiply that across a meaningful silver position. 1,000 ounces, 5,000 ounces, 10,000 ounces. The cost basis documentation problem becomes an extremely expensive oversight very quickly. And here's the part that makes it even more urgent. Most silver investors who have been stacking for several years have bought silver at multiple different prices, across multiple different transactions, from multiple different dealers. Each of those transactions has its own cost basis, and without records of each individual purchase, you cannot prove any of them. Let me now walk you through exactly what counts as cost basis for silver. Because most investors dramatically underestimate their actual what counts as cost basis, because they only count the spot price they paid. Your cost basis includes far more than spot price. Component 1, the purchase price including all premiums. When you buy silver from a dealer, you pay spot price plus a premium. That premium is part of your cost basis. If you bought American Silver Eagles at $25 per ounce when spot was $22, your cost basis is $25 per ounce, not $22. Every dollar of premium you paid above spot is part of your basis and reduces your taxable gain when you sell. This is confirmed directly by IRS Publication 544 and multiple precious metals tax guides. Component 2, shipping and handling costs. If you paid for shipping when ordering silver online, that shipping cost is part of your cost basis. It is a legitimate expense directly associated with acquiring the asset. Component 3, insurance costs during transit. If you purchase shipping insurance on a silver order, that cost adds to your basis. Component 4, storage fees for IRA-held silver. If your silver is held in a self-directed IRA at an approved depository, the annual storage fees paid are a legitimate investment expense that can be factored into your overall cost picture. Component 5, appraisal and authentication costs. If you paid for professional appraisal or authentication of silver you purchased, particularly for numismatic or collector coins, those costs can be added to your basis. Component 6, sales tax paid at the time of purchase. In states that charge sales tax on precious metals purchases, the sales tax you paid is part of your cost basis. Every dollar of documented acquisition expense increases your basis and reduces your taxable gain. This means the actual taxable gain on your silver position is almost certainly lower than a simple spot price comparison would suggest, but only if you can document and prove every component. Now, let me walk you through the actual calculation step by step. I am going to use a realistic example that most silver stackers will recognize from their own buying patterns. Investor Profile bought silver across 3 separate purchases over the full calculation step 4 years. Is Purchase 1 January 2021, 50 American Silver Eagles, price paid $28 per ounce, including premium shipping $5. Total cost $1, $45 cost basis per ounce, $2,810. Purchase 2 March 2022, 100 ounces of 999 fine silver bars. Price paid $24 per ounce, including premium. Shipping $8. Total cost $2.48. Cost basis per ounce, $248. Purchase 3, September 2023, 75 American Silver Eagles. Price paid $26 per ounce, including premium. Shipping $6. Total cost $1,956. Cost basis per ounce $268. Total silver owned $225.00. Mix of Eagles and generic bars. Total cost basis $5,769. Average cost basis per ounce $25.64. Now this investor decides to sell 100 ounces of silver at $85 per ounce in 2026. Sale proceeds $8,500. Now here is the first important decision they face. Which ounces are they selling? Because the cost basis differs between their Eagles and their bars. And the IRS requires you to specifically identify which lots you are selling when you have multiple purchase lots at different prices. And this is called the specific identification method. The specific identification method is one of the most powerful tax planning tools available to silver investors, and almost nobody uses it correctly. Here's how it works. When you have silver purchased at multiple different prices and you are selling a portion of your total position, you can choose which specific purchase lot you are selling. You are not required to sell on a first and first out basis. You can sell the highest cost basis ounces first to minimize your taxable gain. Going back to our investor example, if they sell 100 ounces at $85 and the specific identification, choose to sell from their highest cost basis lots first, their January 2021 Eagles at $28.10 per ounce, their taxable gain is smaller than if they sold their lowest cost basis bars first, selling 50 Eagles from the January 2021 purchase at a $2,810 basis. Gain per ounce is $85 US, $2,810, which equals $56.90. Gain on 50 Eagles is $2,845. Then selling 50 bars from the March 2022 purchase at a $248 basis. Gain per ounce is 85 US, $248, which equals $60.92. Gain on 50 bars is $3,406. Total taxable gain using specific identification, $5,891. Tax at 28%, $1,649. Now compare that to selling the lowest cost basis lots first. If they sold 100 bars from the March 2022 purchase at $248 per ounce. Total taxable gain, $6,092. Tax at 28%, $7,560. The difference is $56.60 in this example, small on 100 ounces. But multiply that across 10,000 ounces, and the strategic use of specific identification saves you $5,660 in a single transaction. The specific identification method requires that you specifically identify the lots you are selling at the time of the sale, not after, not when you file your taxes at the time of the sale. This means your documentation needs to be organized before you sell so you can make the strategic choice while it still matters. Now let me cover the 3 special scenarios that change how cost basis works in ways most silver investors have never heard about. Special Scenario 1. Inherited silver. When you inherit silver from someone who has passed away, something powerful happens to your cost basis. It gets reset. This is called the stepped-up basis rule. Under current tax law, when you inherit a capital asset, including silver, your cost basis is generally reset to the fair market value of the silver on the date of the Special Scenario 1 inherited original owner's death, not what they originally paid, the value on the date they died. Let me show you exactly how significant this is. Your grandfather bought 1,000 ounces of silver in 1980 at $5 per ounce. His cost basis was $5,000. He passed away in 2024 when silver was trading at $30 per ounce. His estate value for that silver was $30,000. You inherit it. Your stepped-up cost basis is $30,000, not $5,000. If silver then rises to $100 per ounce and you sell, your taxable gain is calculated from the $30,000 stepped-up basis, not from your grandfather's original $5 per ounce purchase price. The $75,000 gain from $5 to $80 per ounce that accumulated during your grandfather's lifetime effectively disappears for capital gains purposes at the inheritance transfer. This is not a loophole. This is the tax code working exactly as written, and it is one of the most compelling reasons why long-term silver holders with significant unrealized gains should consider the estate planning implications of their stack before they sell. Special Scenario 2. Gifted silver. When someone gives you silver as a gift, the cost basis rules are different from inheritance. For gifts, you generally receive what is called a carryover basis. Your basis is the same as the original owner's basis at the time of the gift. If your father bought silver at $20 per ounce and Gift Special Scenario 2 gifted it to you when silver is $80 per ounce, your basis is still $20 per ounce. You do not get a stepped-up basis like you would through inheritance. However, there is an important exception. If the fair market value of the silver on the date of the gift is less than the donor's original cost basis, the rules for calculating gain or loss become more complex. In those situations specifically, which would mean silver declined in value, the calculation depends on whether you eventually sell at a gain or a loss relative to both figures. This complexity is why keeping records of original purchase prices matters even for silver you received as a gift. Special Scenario 3. Silver. Received in exchange or trade. If you exchanged other assets for silver in a barter or trade transaction, your cost basis in the silver is generally the fair market value of the silver at the time you received it, or the fair market value of what you gave up in exchange, whichever is more clearly established. Special Scenario 3. Bartered. Barter transactions involving precious metals are taxable events. They must be reported, and the cost basis established at the time of the exchange is your starting point for any future gain calculation. Now let me give you the exact spreadsheet structure that every silver investor needs to build today. This is not complicated. It is a simple document that you maintain from this point forward and reconstruct as accurately as possible for past purchases. Column 1. Date of purchase. Column 2. Dealer or seller name. Column 3. Product type. Eagles, bars, junk, silver, rounds. Column 4. Quantity. Number of ounces or coins. Column 5. Total price paid, including all premiums. Column 6. Shipping cost. Column 7. Other acquisition costs, sales tax, insurance, appraisal. Column 8. Total cost basis for this purchase. Column 9. Cost basis per ounce. Column 10. Payment method. Cash, check, wire, card. Column 11. Receipt or documentation reference. File name or folder location. That 11 column. The 11-column spreadsheet gives you everything you need to calculate your gain on any future sale. Apply the specific identification method strategically. Defend your cost basis in any IRS audit and understand your real tax exposure at any current silver price. For past purchases where you no longer have original receipts, reconstruct as accurately as possible using bank statements, credit card records, email order confirmations, and memory. Partial documentation is better than no documentation. Document what you can. Note the gaps honestly and start clean documentation on every purchase from this point forward. Store the spreadsheet and all supporting documents in at least 2 locations. Digital backup in cloud storage, physical printed copies in a secure location. These records need to survive for at least 3 years after you file the tax return that reports the final sale. And if there is any possibility of fraud allegations, the IRS has no statute of limitations. For tourist surrenders saying state's insurance, let me bring everything together with the clean summary. Your cost basis is the total of everything you paid to acquire your silver, including purchase price with all premiums, shipping, insurance, sales tax, and other acquisition costs. Every documented dollar of cost basis reduces your taxable gain in your tax bill. IRS assumes a zero cost basis. If you cannot prove what you paid, zero basis means. Series final summary. Your entire sale proceeds become taxable profit. The specific identification method allows you to choose which purchase lots you are selling to. Minimize your taxable gain. Use it strategically and document your choice at the time of sale. Inherited silver receives a stepped-up basis to fair market value at the date of death, which can eliminate decades of unrealized gains for tax purposes. Gifted silver carries over the original owner's basis, which means you inherit their tax exposure along with the metal. The 11-column spreadsheet I described is the single most practical tool for protecting your silver gains from unnecessary tax. Build it today. Maintain it on every future purchase. Reconstruct it as accurately as possible for past purchases. This is the final video in the Silver Laws series on RateScope. Over these 6 videos, we have covered the 3 laws closing in on silver owners, the digital fence and how to navigate it, the American Silver Eagle reporting exemption, the Roth IRA strategy that eliminates the collectibles tax entirely, the IRS audit triggers that catch investors who think they are invisible, and now the cost basis calculation that determines exactly what you actually owe. You now have more practical knowledge about the legal and tax frameworks surrounding silver ownership than the vast majority of investors in this market. Use it, document everything, report accurately, and keep more of what your silver earns. If this series gave you clarity that you could not find anywhere else, hit subscribe. RateScope covers silver laws, IRS rules, and market reality every week. No hype, no agenda, just the data and what it actually means. Drop your questions in the comments. I read every single one. Logic, not hype. See you in the next.